All right. Hi, everyone. Welcome to today's webinar brought to you by Vantage Markets. So today we'll be looking at the central bank spotlight. So today we'll be looking at the RBA or the Reserve Bank of Australia. I just want to let you know we're streaming in directly into the Vantage app as well as over Zoom. Right, so do not hesitate to drop your questions in the Q&A box as we move along during this presentation. All right, before we start, let's just quickly go through the disclaimer. Please take note that the information, context, opinions which are expressed in this presentation and on the following slides are solely those of the presenter and not necessarily those of Vantage, and are solely used for educational purposes as they do not constitute investment advice and or consultation on how a client should trade. Also, take note of the risk warning that comes with trading margin forex and CFDs as they carry significant risk and is not suitable for all investors. My name is Ketan Ramachandra. So this webinar series is brought to you in a special partnership between Vantage Markets and Everest Fortune Group, where we have been the finalists for Best FX and Equity Research for the following years, 2019, 2020, and 2021. Right, okay, so here's the agenda for today. Right, okay, so we had the most recent RBA meeting take place on the 7th of May, right, just about a couple of weeks ago. So we're going to be looking at the key takeaways from the statement, and also we're going to be looking at was there any significant shift in messaging from Governor Michelle Bullock, right? She had a press conference following this release of the statement. And then we'll also look at what does it mean for the Aussie moving forward, right, for the Aussie dollar. But of course, before we look at that, right, we have to look at the state of the economy, the labor market, and GDP output as well. And then to get a sense of how the overall Australian economy is coming along, and then we can see how that's likely going to impact the RBA's decision-making process, as well as how it would impact the Aussie dollar as well, the direction of the Aussie dollar. All right, so let's start with the meeting, the RBA statement, right? So basically, right, these are the key takeaways, right? The RBA left the cash rate unchanged at 4.35% on the 7th of May, right? This marked the fourth consecutive meeting when rates were kept on hold, right? Although we are continues to see price pressures ease, the pace of moderation was slower than expected due to persistent service inflation. So while the manufacturing sector has been in contraction, when you look at the PMI numbers, services PMI has been pointing to 3 strong months of output. That of course leads to higher prices as well. So when PMI output is strong, demand is also strong, which also would lead or would cause prices to remain elevated, right? So that's what we're seeing. Although the pace of moderation, the rate of inflation has continues to ease, but the pace was slower than previous months, and this is due to higher service inflation. Right. The board members also acknowledged that returning inflation to the target of 2 to 3% is going to be bumpy, right? So take note the RBA has an inflation target of 2 to 3% on an annualized basis, and they have now realized although inflation prior in 2023 had been easing quite significantly, however, coming into 2024, we have seen the first quarter to be quite bumpy with regards to price pressures, and that means moving forward, we're likely to see not so smooth sailing with regards to the direction of with regards to downward direction for inflation in Australia, right? So inflationary pressures are not going to ease as smoothly as they have in 2023. So we might expect a bumpy ride, and that in turn would cause the RBA to hold rates at current levels, right, at 4.35% for longer than anticipated, right? And of course, there are also uncertainties over the lags that the effects of monetary policy can have, right? Right, the transmission from higher rates into the actual economy can take longer than expected to bear fruit. So the RBA, like many other central banks, are adopting a wait and see approach, and instead of cutting too early, they'd rather keep rates where they currently sit, and then moderate and then continue to assess the incoming data. Right, so these are the key takeaways for the RBA meeting, right? And if you look at the cash rate since 2000, right, or rather, let's just look at the cash rate in the last 3-4 years, right? It was sitting very close to 0%. I believe it was around 0.25 or 0.5%, right, during the lows of 2021 and 2022. And you can see a very sharp rise in the rate of increases, right? It's a very sharp, quick hiking cycle. that's brought it up to about 4.35%, right? So of course, this is not as high as interest rates used to be in the early 2000s to 2010, right? Remember, this was during the strong commodity bull phase, right? So we saw huge demand for commodity prices, and Australia being a huge commodity exporter with regards to gold, copper, and iron ore, especially iron ore, right? We saw a big demand for that during that period, which caused a lot of, which in turn kept the Aussie dollar elevated, right? The Aussie dollar was at its strongest at this point here in 2000 to 2010. Now, of course, 4.35% based on historical standards is at a pretty high level. And as we can see that there has been, it has worked to at least tame inflation and brought it down to a slightly more acceptable rate. All right, now we'll look at the main points of the statement as well, right? There are three main points. The RBA focused on the first point being inflation remains high and is falling more gradually than expected. So, right, although inflation is heading in the right direction, right, that means it's continuing to ease or moderate lower, but the pace is getting slower as well, right? So underlying inflation is higher than headline inflation and declined less. This was largely due to services inflation, right, which remains high and is moderating only gradually, right? With services PMI continuing to show very strong output, right? This, of course, would keep prices in this sector elevated, and naturally that has an impact on the overall level of inflation as well, right? The data continues to indicate excess demand in the economy, so it's still very strong demand in the economy, specifically for the services sector, right? And coupled with strong domestic cost pressures for both labor and non-labor inputs as well. Wage growth has also been strong throughout the last 12 months in Australia. Looking at the annualized rate, wage growth was as high as 4.1% in the fourth quarter of 2023. It has eased somewhat to 4% in the first quarter of 2021, but then it's still at elevated levels. So wage growth is important as well, because if wage growth continues to accelerate, that means the Australian consumer has relatively stronger consumer spending power, and that also would translate back into retail sales and into the broader economy as well. However, right, the RBA has also noted that inflation still continues to weigh on households' real incomes, and output growth has been subdued. So we are seeing weak household consumption as well, right? Despite wage growth accelerating throughout 2023, it has naturally, of course, not kept up with the pace of inflation, right? Which leads to lower household consumption as well. Now, the second point is the outlook remains highly uncertain, right? So in the near term, inflation is forecast to be higher because of the recent rise in domestic petrol prices, right? If you look at crude oil futures, right, in the first quarter of this year, crude oil futures, if you look at Brent oil and WTI, both have risen quite significantly this year, or in the first quarter of this year, which of course in turn leads to higher petrol prices or gas prices in the US as well, right? So then of course we have higher than expected services price inflation as well, right? So we are expecting in the near term, or the RBA is expecting in the near term, for price pressures to increase due to higher petrol prices and of course services price inflation, and then it will decline more slowly over the rest of the year. So in the third and fourth quarter of the year, we may see the slowdown resume, but at a much slower pace. Now, inflation is expected to decline over 2025 and 2026, returning to the target range of 2 to 3% in the second half of 2025. Right. So currently, inflation sits at about 3.6%, if I'm not mistaken, or 3.7%. I believe, yeah. So they're looking at only in the middle of next year, so which is basically 12 months from now, for inflation to return close to their target range of 2 to 3%, right? So it's still quite a way to go, right? Household consumption growth has been particularly weak, right? As high inflation and the earlier rises in interest rates have affected real disposable income, which in turn causes households to curb discretionary spending and try and maintain their savings as well. And of course, there remains a high level of uncertainty about the overseas outlook, especially on the geopolitical front, right? With the ongoing conflicts in the Middle East and in Ukraine as well, right? All these point to elevated geopolitical tensions, and also raises the level of uncertainty on the global outlook. And the third point that the RBA made note of, which is usually how they end their statement, is returning inflation to target is their main priority, right? So the board expects it will take some time, as we've seen in 2025 to 2026 is when they expect inflation to return to target, right? And they are also going to remain vigilant to upside risk, right? The path of interest rate that will best ensure inflation returns to the target in a reasonable time frame remains uncertain, and policymakers are not ruling anything in or out. So this was a fairly balanced statement, right? So on one hand, they're basically keeping their doors open, right? They do not wish to tie their hands to a future rate hike or rate cut, whereas they're trying to sit on the fence here and try and give themselves time by announcing that they are going to continuing to monitor all incoming data and then make their next move according to what the data presents itself. So should we see an uptick in inflation, then of course we may see more hawkish rhetoric out of the RBA. They may not raise the cash rate so soon, right? But they may switch to a more hawkish rhetoric in order to jawbone the Aussie higher, right? And of course, if we do see inflationary pressure starting to ease more significantly in the coming months, then yes, they may turn a little bit dovish, or perhaps they may even surprise with or they may even come out with a surprise rate cut, right? So the board will rely on incoming data and the evolving assessment of risk. All right, now we'll look at was there any significant shift in messaging from the RBA. So basically, from this point of view of the statement, the RBA statement was fairly straightforward. There's nothing new from there. There was actually pretty much the same sort of messaging from the meeting in March to the current meeting in May, right? So the statement offered no new clues. It was fairly well balanced, right? With the RBA sitting on the fence with regards to any future rate cuts or rate hikes. However, during the press conference, right, Governor Michelle Bullock had made some pretty dovish statements, right? So in this press conference of hers, she leaned on the dovish side, where she stated that a rate hike. Oh wait, okay, so before that, right, in the previous meeting that took place in March, Governor Bullock stated that a potential rate hike could not be ruled out, right? So she was pretty this was a little bit more on the hawkish side. However, in the latest meeting which took place in May, right, she stated that the board seems fairly confident that they will not need to hike again, as the cash rate currently sits at an appropriate level in order to bring down inflation. So in this case, there's a significant shift in messaging from Governor Bullock during her press conference, right? Remember in the previous meeting in March, she said that a rate hike could not be ruled out. However, in this latest meeting, she has stated that the board, not only her, but other policymakers as well, are fairly confident that they seem that they do not need to hike anytime soon. Right? Although inflation is going to be bumpy, the path of inflation is going to be bumpy, but they do not see any potential rate hike as well. So they've now shifted to a more dovish stance. Right? Although they may not cut rates at the next 1 or 2 meetings, but it does look like they have shifted to a more dovish stance, and this is quite likely going to continue in the near future, right? So when they have shifted to the dovish stance as well, this may put some downward pressure on the Aussie as well. All right, now what does it mean for the Australian dollar moving forward, right? So before we get into the currency pair itself, the Australian dollar, US dollar, right? We'll take a look at the state of the overall economy. Right. So if we look at GDP, right, GDP has been fairly stable throughout 2023 and also from 2022, although the rate of change on a quarterly basis has dropped below 2% recently, right? But overall, the Australia's economy has been chugging along pretty well, partly in due to the higher services output. Right. So when we look at trade balance as well, trade balance has been fairly strong throughout 2023 and early 2024. However, the last couple of months in February and March, we've seen a drop off in trade balance as well. The trade surplus has actually decreased, even though they've seen higher or larger outbound shipments to Australia's largest trading partner, which is China. Trade surplus has sort of dwindled, right? Dwindling trade surplus can also have an impact on the value of the US Australian dollar as well, right? So that means there are more imports than exports. So if there's less exports out of Australia, that means there's less demand for the Aussie dollar as well. So should we see trade surplus remain at somewhat depressed levels, or even worse, if it goes negative, a trade surplus turns into trade deficits, then of course the Aussie is also going to come under significant overhead pressures as well. Right, looking at PMIs, remember we talked about the services sector pulling up overall economic growth in Australia, right? So when I look at the charts here, on the left I have the chart for manufacturing PMI, on the right I have the chart for services PMI. Right, for PMI readings, a reading below 50 indicates contraction, whereas a reading above 50 indicates expansion. So as you can see for manufacturing sector, right, for the manufacturing sector, for most parts or for almost its entirety of the last 12 months, it has remained in contraction, except with the exception of January's figure. January's figure registered a small expansionary print. However, this was very short-lived, and then it proceeded to fall back into contraction again. However, if you look at the services sector, it presents a much better output as well. This sector has been chugging along quite well, and especially in the first quarter of 2024, it has rebounded very strongly, expanding very strongly in February, March, and April as well. Right, as you can see here, higher due to stronger demand in the services sector. Right, it has led to higher energy, labor, and of course input material costs as well, which is then has a major impact on the overall level of inflation and also the pace of disinflation as well. Right, then when we look at the composite PMI, you can see that composite PMI has rebounded strongly as well in the first quarter 2024, moving up into expansion, partly due or mostly led by the services sector, right? So you can see the services sector has indeed pulled up overall economic growth in Australia, and has also led to higher employment levels, and also overall price inflation has somewhat eased as well. But services is still pulling up the overall. Also, for the services sector, price pressures still remain elevated. Right, now here we come to inflation. So on the left, I have the chart for CPI data on an annualized basis for every quarter. And on the right, I have the monthly indicator. So on the left, I have the quarterly indicator for CPI on an annualized basis. And on the right is the monthly CPI indicator on an annualized basis as well. So as you can see here, since throughout 2023, inflation has moderated quite significantly, which was as high as 7.8% in the fourth quarter of 2022. And coming into January, the first quarter of 2024, we have seen it decelerate all the way down to 3.6%. Right, the direction is good, the trend is good, is moving in the right direction. However, it is still well above the RBA's target of 2 to 3%. Now, when you look at the monthly CPI data indicator, right, over the last 4 months, it has been somewhat flat, right? It has been at 3.4% from December of 2023 to February of 2024. However, it edged a little bit higher to 3.5% in March. Now, should the price pressures from the services sectors spill over to the overall, or has a larger impact on the overall CPI number, we could see the monthly CPI indicator for the month of April probably edge higher once again, right? So this is the worry here. So on an annualized basis, when you look at the quarterly rate, is moving in the right direction. However, when you look at it on the monthly indicator, what was previously a downward trend since September of last year has somewhat stabilized, and it edged higher in March. So this is a slight concern for the RBA, because should we see April's figure edge higher again from 3.5% to maybe 3.6 or 3.7%, right? This means that the RBA is most definitely not going to cut rates anytime soon, and they may even switch to a dovish stance. Right. When you look at home prices as well, they'll be looking at home prices as well. Right. Higher rates did help to cause home prices to decelerate on an annualized basis. Right. They were growing. Australia's home prices were growing very strongly, right, reaching as high as almost 24% in the fourth quarter of 2021, and then prices started to decelerate at a nationwide level since then. And prices even contracted right in the fourth quarter of 2022 and in the first 2 quarters of 2023. However, we are seeing a re-acceleration in home prices as well, which is what the RBA is also keeping an eye on as well. So if we see home prices continue to accelerate even further, right, it means that interest rates are quite clearly not restrictive enough to curb rising home prices as well. So this may mean that although they may not raise interest rates or they may not raise the cash rate, they're quite likely to maintain it at the current level of 4.35%, at least for another quarter or two. Right, and you can see consumer spending has been somewhat mixed on a monthly basis. Consumer spending has been mixed since the second half of 2023, right? And then when you look at it on an annualized basis, it's actually trended lower as well. So you can see how household consumption has been negatively impacted as well. Remember the statement and the press conference both highlighted weakening or weaker household consumption in Australia, and that's reflected in retail spending figures as well, both on a monthly basis and on an annualized basis as well. And looking at employment, finally looking at employment, right? Jobs growth has been a little bit mixed since December of last year, right? Although we did see a very strong jobs growth for the month of February, but this looks to be more of an anomaly rather than the norm, right? So we may see jobs growth starting to moderate moving forward. And what's worrying is this uptick in the unemployment rate. So in the third and fourth quarter of 2023, we did see the unemployment rate pick up very significantly, going from about 3.6% to as high as 4.1%. In January, however, we saw the unemployment rate drop quite drastically in February, which is a good sign. But however, we are now seeing this acceleration in unemployment rate once again. So should unemployment rate continue to rise higher, of course, we may see job growth coming week as well. Now, should the labor market break in Australia, right, that means the RBA may move to cut interest rates as well, right? They may not need to see inflation come closer to their target of 2 to 3%, especially if there's a major breakdown in the Australian labor market. Remember, if jobs growth turn negative, right, on a monthly basis, if companies actually start to shed jobs regularly on a monthly basis and the unemployment rate starts to accelerate even further from 4.1%, right, the RBA may actually even start cutting rates even before inflation reaches its target. Remember, the labor market is going to provide a very strong signal as well as to how soon the RBA would cut. All right, now let's move on over. Now that we've covered the state of the overall economy in Australia, let's take a look at the Aussie dollar itself. All right, so here I am on the chart for the Australian dollar, US dollar, otherwise known as the Aussie, currently on the daily time frame here. Right, if you zoom out a little bit and look at it on a weekly basis here, you can see that since May of 2021, right, you can see that the Aussie has been in a strong downtrend as well, right? In the longer term downtrend, the longer term trend is to the downside here, right? We see a pretty decent descending trend line as well over here. So it's also important to realize how this currency pair is actually trading as well, right? In response to what the reaction function of the RBA is also going to be. Right, and also another important factor to take note of is also what the Fed is going to do. Remember, currency pair involves two currencies, the Australian dollar and the US dollar. So we're going to focus on the Australian US dollar, otherwise known as the Aussie. We have to look at what the Fed is doing in addition to what the RBA has planned as well. And you have to look at which is the more dominant central bank, or which central bank has adopted a path that's going to have a larger impact on the direction of the Australian dollar. Of the Aussie, sorry, Australian US dollar, right? So take note, we're not only going to be looking at the RBA itself in isolation, right? You can't just look at the RBA in isolation, right? We also have to look at the other side of the table and take a look at what the Fed is doing as well. Now, if the Fed turns out to be more aggressive with regards to rate hikes than the RBA, that means we could potentially see like the Aussie even maybe climb a little bit higher, right? So if the Fed is going to cut rates faster, maybe demand for the dollars is going to, US dollar is going to wane, while demand for the Aussie dollar might remain relatively elevated, right? So we have to take note of the differential between monetary policy actions between the Fed and the RBA as well. Right. So you can see there's a nice descending trend line here that's been in place since February of 2021. When you look at the Aussie on a weekly time frame, this is a very important trend line. Now, should we see this trend line break above? Is it going to have a potential bullish breakout, or is it just going to be a fake out like what we saw here in April of 2022? So take note. Structurally wise, Aussie US dollar, the Aussie has been in a strong downtrend, right? When you look at it on a longer term time frame, and this is a major resistance point to take note of as well. Right, on the lower side, you can see there's a pretty descending trend line as well. Sorry, ascending trend line, right? So sort of when you look at it here, we see like a asymmetrical triangle. Is not the best symmetrical triangle, sorry, but it is still a pretty decent one to have, right? Although you can see the bottom of this wick here on March of 2020, dropping below the ascending trend line here, or but generally we see we have a nice symmetrical triangle, and its price is converging towards the center of the to the final point of the triangle here. So this is an important chart pattern as well. So symmetrical triangles are difficult to call because you can have a bullish. There's no definitive direction in where the breakout could occur. It could be a bullish breakout or a bearish breakout, right? But for now, you can see the Aussie dollar, at least on the weekly time frame, is converging towards about 65, 30 cents, right? 65.30. Right, remember, so we have two very important trend lines for the Aussie, right, which results in a symmetrical triangle chart pattern. All right. Now, of course, with the Aussie currently running into resistance last week. Remember last week the Aussie climbed as high as about 67 cents, right? So it's trading quite close to its immediate resistance level here at 66.93. So that's where the immediate resistance level for the Aussie sits, which is at 66.93, right? It's about 20 pips from where it is currently trading. And of course, the second major resistance level for the Aussie is going to be this swing high resistance here that occurred on December of last year, which is at 68.25. Now, with regards to this first support, we see a very nice swing low here, or pullback support level here at 64.22 that occurred on 15th of April. So very clearly, that's the first major support. And the second one is this swing low here that took place on the 9th of October. Right, if you can look at the Ichimoku cloud, let's see if there's anything. Right, you can see it is still trading below the Ichimoku cloud on a weekly time frame. Let me see if I can highlight the cloud a little bit more clearer. Yeah. There we go. This is a little bit better, right? So remember, the bearish Ichimoku cloud indicates the general direction or momentum for this currency pair. So when the cloud is red in color, it indicates a strong bearish momentum, right? And with the currency pair trading underneath the bearish Ichimoku cloud as well, right? The cloud itself can also identify areas of resistance. So every time the Aussie rises into the bearish Ichimoku cloud, the cloud itself helps us to highlight a major resistance area. And you can see quite clearly the Aussie has stalled in this cloud several times, right? When we look at it, it stalled here in the bearish Ichimoku cloud in April of 2022. It stalled here and reversed strongly again in January of 2023. And here as well in June and July of 2023 as well. This too is not so clear here. And then here, it did break above the Ichimoku cloud, but this was a false breakout. It actually got stalled at the descending trend line before moving lower. And now there's two areas of resistance, right? We have the ascending trend line and the bearish Ichimoku cloud itself to identify a potential or major resistance zone as well, right? So you can see how the cloud and the descending trend line can help us identify a major resistance zone, right? Of course, resistance zones can be broken, we may see a potential bearish breakout, a bullish breakout occur. But as you can see here, this is a very significant trend line that's been in place since February of 2021. It would take something very significant to break this structurally downward move here, right? This downward trend is a very strong downtrend here, and it's going to take something major, a major structural shift to see a potential bullish breakout, right? So that would mean we're going to see the Fed be less aggressive, the Fed be more dovish, and the RBA be more hawkish, right? Could that potentially happen, right? Right. There is a possibility, but what is the but potentially maybe not. It's not quite likely it's going to happen, because when you zoom out as well, right? Since 2020, since 2012, right, the RBA has been more uh, I would say dovish as well, or more aggressive with its easing pressures as well. As you can see, the Aussie has lost value as well as at one point in time, where the Australian dollar was on parity with the US dollar, and briefly in 2011, it even went as high as $1.10 versus the US dollar. So, but since then, the Aussie has actually become much weaker structurally over time, right, and has actually become significantly weaker than the US dollar over this period here. Right, so this is a very strong structural move or trend in the Aussie. So right, of course, we can see it break a little bit higher, but whether we look at it in the longer term framework, right, the Aussie does look to be getting weaker, progressively weaker versus the dollar over time. All right, okay, with that, now let's go on and see what's going to happen. Remember, okay, we had the RBA release its monetary policy statement on 7th of May, and we've got the Fed coming up next month in about 2 weeks. So I think it's on, if I'm not mistaken, it's going to be on the 11th of June. Let me see. It's going to be on, right, the 12th of June, right? 12th of June. That's when the Fed will release its monetary policy statement as well, and followed by Chairman Jerome Powell's press conference. Right, given that inflationary pressures in the US picked up in the first quarter of 2024, right, should we see inflation remain persistent in the US, right? It may not have to accelerate strongly, but it may just have to remain at current levels. That may be enough for the Fed to remain hawkish, right? Maybe somewhat slightly more hawkish than neutral, and that could cause the Aussie that could cause demand for the US dollar to remain elevated, and that could potentially put the Aussie dollar on a downward pressure once again, right? So remember, we have the upcoming date FOMC meeting as well. But in between that, right, we may also see other incoming data such as PMI data, inflation, non-farm payrolls in the US that could potentially keep the demand for the US dollar stronger than the Aussie. So that means we may see the Aussie dollar here reverse and potentially drop lower. All right, okay, with that, now let's move on over to the daily time frame and try and fine tune the analysis. Right, okay, so here, first resistance is at 66.90. That's quite clear here. Second resistance is the swing high that occurred in December of 2023. First support is here at about 64 cents. Okay, this was on the weekly time frame, remember. But of course, there's intermediate support levels that we can try and identify as well, right? One of them, another intermediate support level is going to be at this pullback level here, or maybe it's even an overlap. Right, this is a pretty decent pullback support level as well, or overlap level here for the Aussie. So we have a support level 66.44, or 66.40, sorry. Right, so we can see since 15th of May, right, since last Wednesday, the Aussie has been sort of consolidating between 66.40 and 66.93. So just trading within a relatively narrow range, not so narrow range, but a relatively smaller range of about 50 pips or so, right? It's trying to find direction here. But when we look at it here, this is a pretty strong bullish move as well. We have a nice bullish channel for the Aussie over here as well, right? It's tested the lower trend line of this bullish channel several times while running into resistance in the upper trend line several times as well. Now it's approaching a pretty significant area here. We have this, remember this long-term weekly descending trend line, and could the Aussie potentially stall around here as well, right? Maybe it could, right? Quite likely it could stall around here as well. And should we see the Aussie break out of this bullish channel, that's going to give us confirmation of a major reversal for the Aussie as well. So remember, it's approaching this longer term descending trend line that's seen on the weekly time frame. And should we see the Aussie stall around 67 cents and then reverse and break out of this bullish channel, that would give us a very strong indication that we have a major change in the trend, right, in the near-term trend, and we're going to see the Aussie pull back potentially towards 65.50. Right, so take note. Okay, so the first intermediate support level is at 66.40. The next intermediate support would be here. The next support level would be at 65.65. Finally, another pullback support level here at 64.70, and finally the first major support that's been identified on the weekly time frame is at 64 cents itself. So you can see how we've identified the various support levels as well. The support levels will help us identify potential take profit levels should the Aussie reverse, right? So any short Aussie trades that we may have, we can then use these respective support levels and use them to identify potential take profit levels for the short trades. Right, okay. So as you mentioned, the next resistance level here is at 68.47. Are there any other intermediate resistance levels that we can try and identify? Perhaps we can, right? Let's try and run a Fibonacci retracement from here. This swing high on the 28th of December, going down to the swing low here on the 19th of April. Let's pull up the 61 and 78.6 retracement levels. All right, we can see Aussie has already crossed 61.8, so that's no longer valid. Let's get rid of that. Let's just keep 78.6. So the next major intermediate resistance level could be around here at 67.61. Right, 67.61 is where the next major resistance level could come in should we see this bullish breakout occur. I remember we saw a bullish breakout occur in April of 2022 as well, but this was pretty short-lived. And when we look at it here, the Aussie broke above this trend line for about 3 days, but it was a failed breakout and it then reversed sharply to drop low as well. So do take note, we can have false breakout once again, right? We may, if that false breakout occurs, if the bullish breakout occurs, it may stall at this intermediate resistance at 67.60, right? Take note of that, right? Of course, there's always a strong possibility that we have a bullish breakout on hand. But remember, any bullish breakout opportunities, right? We can identify a suitable take profit level for the long bullish breakout at this intermediate resistance that aligns very well with the 78.6% Fibonacci retracement. All right, so these are the key levels for the Aussie on the daily time frame. But now let's look at something on a 4-hour time frame. Right, so when we look at it on the 4-hour time frame, we can see that the Ichimoku cloud has actually turned green. So this is indicating a strong bullish momentum. And with the currency pair itself trading above the Ichimoku cloud highlights the bullish trend as well. And remember, when a cloud is green in color, the cloud can offer areas of support as well, which is what happened here in May of 2024, even here 9th of May of 2024, and also here on the 14th of May as well. Now, as you can see, the Aussie is trading close to the Ichimoku cloud. Once again, the bullish Ichimoku cloud. This cloud could then help us identify a potential area of support, right? So with the lower trend line of the bullish channel and the cloud itself, it helps us identify a long opportunity for the Aussie too. And when I look at this intermediate support level here at 66.40, right, that also highlights a major support level. Right, so we have 3 factors that help us identify a strong support zone on the shorter term time frame, right, which is the 4-hour time frame. When you look at it on a 4-hour time frame, we have the bullish Ichimoku cloud, the lower trend line of the bullish channel, as well as this overlap support at 66.40. All 3 factors highlighting a potential major support zone for the Aussie, and that helps us identify a long opportunity as well. Right, so going long at the Aussie around between 66.40 and 66.50 may be a pretty decent opportunity to capitalize on this uptrend here. Right, so should we see price, should we see this currency pair bounce off this support zone here, then of course we're going to target the first resistance as the potential take profit level. So we have about at least a pretty decent 40 to 50 pip take profit opportunity here based on this support zone. Right, okay. There's also Fibonacci retracement I believe we can use. Let's start this retracement here from this swing low on the 19th of April going up to the high of last Wednesday. Right, let's pull up all the fibs. Right, we can see that the 23.6% sits pretty close to where the pullback or the intermediate support at 66.40 has been identified. And we also see another retracement close to the other intermediate support as well. So let's keep 23 and 38%. And highlight these support zones as well. So you can see here the first major support zone on the 4-hour time frame has now 4 factors identifying a major support area. We've got the bullish Ichimoku cloud. We've got the 23.6% Fibonacci retracement. We've got this intermediate resistance at 66.40. And finally, we also have the lower trend line of the bullish channel. So 4 factors pointing to a very strong support zone here, which gives us a good opportunity to go long on the Aussie around here. And of course, putting the stop loss about 10 to 15 pips underneath the 23.6% Fibonacci retracement would be a suitable level as well. We do not wish to keep a very wide stop loss, of course, right? Because if it breaks out of this lower trend line here of the bullish channel and it breaks through the Ichimoku cloud, that means we may have a potential correction or reversal in trend for the Aussie, and you do not wish to have a very wide stop loss that's below the 23.6% retracement. So placing the stop loss at about 10 to 15 pips underneath this 23.6% retracement would be a suitable level as well, right? Without risking too much on the overall trade. All right, okay, so that's what we have for the Aussie. Let me check if there's anything to watch out for the Aussie this week. All right, I'm going to pull up the calendar from Forex Factory. Oops, wait, that's next week. I need to look at this week. Right, okay, here we go. So here's the calendar from Forex Factory for this week. Right, so we just got the US and Aussie economic data that's coming up. Right, so today's Tuesday, so we've got a few things. We've got Governor Waller speaking tonight. We've got FOMC meeting minutes coming up tomorrow. We've also got unemployment claims, PMI data in the US, and also durable goods orders as well. So more data related to the US. So of course, if these data points are going to result in stronger result in higher numbers, higher than expected numbers with regards to PMI numbers or durable goods orders, right? This is going to, in turn, going to have a positive impact on the US dollar. So then that could potentially mean the Aussie is going to come under pressure and reverse as well. So take note, we have a lot more incoming data for the US for the second half of this week. And should PMI data and durable goods order come in stronger than their respective forecasts, we may see demand for the US dollar pick up. Then that in turn could potentially mean the Aussie is going to stall and reverse to drop lower as well. So take note how the macroeconomic data can also impact the direction of the Aussie as well, right? And that would sort of come in line with the longer term trend, right? Okay, let me try and remove all this. Right, that would sort of come in line with the trend because as you can see here, the Aussie is trading very close to this descending trend line on a weekly time frame. So should we see all these data sets, existing home sales, unemployment claims, PMI numbers, new home sales, and durable goods orders come in higher than their respective forecast or come in stronger to point to a very robust economy in the US, then of course that would mean demand for the dollar could skyrocket, right? And that would mean that in turn is going to cause the Aussie to experience a sharp bearish reversal. So take note of that, right? So not only do we have a major technical descending trend line in place to stall the rise in the Aussie, we also have potential macroeconomic data that could cause the Aussie to stall and reverse as well, right? So take note of that. All right, so that's what we have for today, right? I hope this has been a great session for you. Do take note that next upcoming meeting that's going to impact the Aussie is going to be the FOMC meeting that's up on 11th and 12th of March. And the next RBA meeting is going to be towards the end of June as well. Let's just check that out before we go. RBA schedule 2024. Right, so when we look at the RBA, remember we just had May's meeting conclude on 7th of May, and the next meeting is going to be on the 18th of June. So just a week after, right? So we'll have FOMC. We'll have FOMC on concluding on 12th of June. Then we will have following the next week, the following week, we will see RBA conclude on 18 as well. So do take note of these two calendar dates as well. And that's also going to have a huge impact on the direction of the Aussie. All right. All right. With that, thanks everyone for tuning in to today's webinar. Do look out for all upcoming webinars by Vantage Markets. And I hope to see you all at the next session. All right. Take care and have a great trading week.